2026 is going to create two types of people: the ones who positioned their money early and the ones who kept waiting. The truth is, wealth rarely happens by accident. It happens because someone made a decision before everyone else felt comfortable. And right now, as we move into 2026, the biggest opportunity isn't finding a secret investment, it's building the right strategy. Most people invest emotionally. They follow headlines. They chase whatever is trending on social media. They jump in when prices are high and panic when things pull back. Smart investors do the opposite. They focus on long-term value. They diversify, and they understand that risk and reward always move together. So, if I were looking at 2026 with fresh capital, here's how I'd think about it. First, I would build a foundation with broad exposure to the overall U.S. economy. Instead of trying to guess which single company will dominate, owning a diversified basket of leading companies spreads risk while capturing growth. A benchmark many investors follow is the S&P 500, which represents 500 of the largest companies across multiple industries. When innovation expands, when infrastructure grows, when productivity increases, broad exposure allows you to participate in that expansion without betting everything on one name. It's not flashy, but foundations rarely are. They're built to last. Next, I would look closely at artificial intelligence and technology infrastructure. AI isn't a future concept anymore. It's already reshaping industries. From automation and robotics to data processing and enterprise software, the backbone of this transformation is being built now. Companies like NVIDIA are powering advanced computing systems, while firms such as Microsoft are embedding AI directly into business ecosystems used by millions. The key here is not chasing hype applications, but identifying companies building the infrastructure. Higher growth potential often comes with higher volatility, so position sizing matters. But ignoring this sector in 2026 could mean missing one of the defining shifts of this decade. Then there's real estate, a timeless wealth builder. Land is limited. Population patterns evolve. Cities expand. Even as markets cycle, real assets tied to housing, logistics, and data centers continue to play a central role in economic activity. Migration trends across the United States are reshaping demand in certain regions, and industrial and infrastructure-related properties are seeing renewed focus. Real estate adds something powerful to a portfolio: tangible value. It's connected to physical space, real demand, and long-term development. Whether directly owned or accessed through structured investment vehicles, exposure to real estate can bring stability and diversification. Every strong portfolio also needs balance, and that's where hard assets like gold come in. Gold isn't about explosive upside, it's about resilience. During periods of uncertainty, global tension, or economic volatility, hard assets have historically acted as stabilizers. In a world that's changing rapidly, technologically and geopolitically, having a portion of your capital in something historically steady can reduce overall portfolio swings. It's not meant to dominate your strategy, but it can absorb shocks when markets move unpredictably. And then there's the most overlooked category of all: investing in yourself. In 2026, barriers to entrepreneurship are lower than ever. Technology has reduced startup costs, AI tools increase productivity, global markets are accessible from a laptop. Starting a business, building a personal brand, launching an e-commerce operation, or developing high-income skills can generate returns that traditional investments may never match. This path requires effort, discipline, and patience, but it also gives you control. Your income growth, especially early on, often matters more than your portfolio growth. Increasing your earning power multiplies every other investment you make. So how would I position $10,000 in 2026? I'd think in terms of balance.
Perhaps 40% in broad market exposure, 20% in technology and AI-focused leaders, 20% in real estate exposure, 10% in hard assets like gold, and 10% toward business or skill development. Not because those numbers are perfect, but because the structure creates diversification across growth, stability, and opportunity. The exact percentages depend on your risk tolerance and time horizon, but the principle remains the same. Never rely on a single pillar. Now, let's talk about what to avoid in 2026. Don't put everything into one trend just because it's popular. Don't invest money you might need next month. Don't panic during normal volatility. Market fluctuations are not emergencies. They are part of the process. And most importantly, don't follow loud voices without understanding the strategy behind them. Discipline beats excitement. Strategy beats speculation. 2026 won't reward gamblers. It will reward people who position themselves thoughtfully. It will reward patience. It will reward diversification. And it will reward those who understand that building wealth is less about finding the next big thing and more about consistently making smart decisions over time. The real question isn't what's the hottest investment. The real question is, are you building a structure that can grow through cycles? Because money flows toward preparation, and preparation starts now. If this gave you clarity, drop a comment with where you're positioning yourself for 2026, and let's build smarter this year.